Greetings, everybody. This is Jeff Scott, and this is my top-down review. Today is November 27th, 2021, and I entitled it Was Omicron a Head Fake and Massive Bear Trap, or the Stimulus of the Next Leg Down? For those who are joining us for the first time, I welcome comments either on YouTube under the remarks, or you feel free to email me at hgsidoc@gmail.com. No, this is not Santa Fe. I decided to take my extended family for a Thanksgiving break to Colorado. So we're in Silverthorne, and this is the view from the home that we're in. Took that this morning from my balcony. So beautiful. But before I get on to this most important market review, I want to talk about the end of a 10-year bear market where my beloved Michigan Wolverines finally beat the Buckeyes from that state south of Michigan named Ohio. It was so much fun having family here watching this game, although my wife doesn't come down to the last 10 seconds because she didn't want to jinx it. A true Rocky Mountain High, go blue. It, this is such a big battle historically that HBO did a special about the 10-year war. I went to Michigan in the Bo Schembechler, Woody Hayes era. And so this was a big deal. And if I sound funny, it's because I don't have much of a voice left. As always, this is for educational purposes only. I'm a doctor, not a broker. I'm independent. No one pays me to say good things about their tools. And trading involves risk, and you alone are solely responsible for any decisions you make. I always talk about be your own guru, and by that I mean find smart people, learn for them, then become your own trader, your own style. Whether you're short term, long term, do options, futures, crypto, it's your business. But learn from smart people and create what works for you and become your own guru. I own a lot of software. Most of what I use daily is here: TradeStation, Thinkorswim, and Wealth Charts. HGSI and EdgeRater, I do a lot of my analysis, usually aftermarket, although you can do intermarket updates on HGSI. And then John Person indicators, Dr. K's indicators, Sager's Q tools. You'll find those on my desk as well. Um, highgrowthstock.com is the website for HGSI. I'm not affiliated, but I like to support great programs. This is a great program. Free 30-day trial under investing strategies. You'll see hundreds of movies of how to use the program to make money. Stock patterns are cyclical, and I think I pointed this out last week. High growth stocks fall like rocks, and boy, did they this week. Clearly, it feels like we're heading down stage 4 fear and could fall quite a bit. That said, we've seen this before, and we've seen the market just rocket higher. I think a lot depends on what we hear from Fauci and Scott Gottlieb and others on Monday morning on CNBC about is Omicron going to be a big deal or not. More to talk about that as we go. Since I am concerned, I have raised cash, smaller positions. I have sold premium. I've got puts on my defensively on almost all my stock positions. Some of my option positions are vertical spreads and they're not that much cash at risk. I sell calls to pay for those puts. And I've got a pretty massive triple Q, although I took some profits on Friday, short position as well. TQQQ, the contra ETF. If you look at Friday's review, you don't need me to tell you how awful a day it was for the Bulls. Clearly, the definition of a sea of red. If you look at the major markets, let's just jump into Thinkorswim. I'll show you the good, the bad, and the ugly, mostly ugly. The good. This is a daily chart, and you could see that on Tuesday, actually Monday, because there was only 4 days this week, we actually traded to all-time highs. So as bad as this market is right now, as bad as it feels, we have just come off market highs. Now, new John Person sell signal, big down bar in the S&P futures. We took out the 17-day Would it be natural to expect us to go down to the 50 and then maybe bounce? Absolutely. And let's hope that's what happens if you're still bullish. Or a bounce on Monday from at the open would be great if you're bullish. Also, on the NASDAQ futures, new high set on Monday, sold off since then. Not quite as low in the pattern that, if we move from 16,043 to 15,5, that's another 400 plus, almost 500 um, points there. That actually, it's over 500 points. If we were to fall down to the 50, that would be painful. Hence my triple Q short position. If I look at the Dow futures, let me give you the same amount of days. Um, Not only did it break through the 50, it's heading down to the 200. So it would not surprise me to see further weakness in the beginning of the week. I'll show you some reasons to be optimistic, perhaps, after the initial open. Russell futures, there's some things that are really disappointing here. First thing is that line sort of designates the top of the Darvas channel. So it knifed through the Darvas channel. The bottom of the Darvas channel is probably down here-ish, around 2107. We closed at 2221. So that's another 124 points. And the fact that it broke right through the 200-day moving average says that's got to be in play on the futures market. The VIX spiked. I know the VXX, I think, was up 50%, or one of them was up 50% on Friday. Massive move. That's never a good thing to see if you're bullish, except what happens over the last while after it spikes, it typically comes down. So does it have much more to run? It could. And if we go back to March 20, well, I'm not going to do it on this. I don't have enough data. You could see it goes much higher. We'll look at that at the weekly. And then the dollar, because of the sell-off in the market and the COVID concerns and shutting down and what that might mean with that new variant, the dollar sold off pretty hard. You might expect some gold strength, but didn't last. If we look at the weeklies, I'm not going to spend much time here except to say, look at this. On the E-minis and NASDAQ, you had your all-time high weekly set this past week. And you look at the bubble of all-time highs on both the bubbles for yearly highs, they just happen to be all-time highs. You can see that on the Dow and on the Russell are all within the last couple of weeks. But you could see, especially here on the Dow, a big move down as well as on the Russell. In the context of a weekly chart, the move on the VIX doesn't look nearly as scary, and the dollar looks like perhaps it's topped out here. This was a week to remember, and we'll look at. Excuse me, you're going to hear a little bit of that because, like I said, I screamed too much. And for the troll that has made comments about the noise I make, you don't have to listen, right? That's right. Let's take a look at what happened this week. I think the expected move charts tell you a lot. 4-day week. On Monday, the market opened and then had a range that took it almost to the top of the expected move, came back and closed down for the day. So that was a weekday on Monday. Tuesday kind of looks like a nothing day. Threatened to the downside, closed right where it opened. Wednesday actually traded up to where the week opened. And as of Thursday, on the E-minis, we were back to the open. And then Friday, we opened. I can't remember when, this is futures, so it would have been earlier. They were up, but they just traded down, took out the expected move. Just shows you how big of a move it was. But it all came really on Friday. Look at the NASDAQ futures. You could see on Monday, actually traded up, got close to the upper expected move, and then sold off. Weekday on Tuesday, a bounce on Thursday, and then Friday, just a major sell-off. 83% of the time when I went through historicals, stocks will close within the expected move. So far, the first two I've shown you have closed outside them. What about the Dow? The Dow just blasted through it. on Friday rather. The Russell blasted out. So there's not very many days that are such significant moves that each of the major index futures traded through their expected moves. The market makers lost their shirt. I don't think anybody will feel that sorry for them. I won't. Look at the VIX, traded right through the top. All of it occurred on Friday. And then the dollar trade to the top came back in. So this is the only one of the major futures. And actually, this is the ETF that stayed within the expected move. So the expected move just shows me that it was massive moves to the downside, mostly occurring on Friday. And I'm not sure that the channels that I drew months ago are even important anymore, but I do think it's interesting. We dropped below on the on the spiders. We failed at the lower channel on the Qs. We just gapped down below on the diamonds, and we're back within the channel after failing to hold the upper channel on the IWM. Hard not to feel that this market is pretty darn weak. Back to the PowerPoint. Let's take a look at what's underneath. Rates dropped, mostly, I think, on COVID concerns. And you could see the 10-year and the 30-year came down pretty significantly this week. AD lines, which would be in white on the small stocks and big stocks, rolled over, as did their matching index. The NYSE rolled over hard and took all the major ETFs with it. You can see a list and color coordination up there. And with rates falling, the TLT, the bonds, came up quite a bit. Now, breadth dropped on stocks above the 200, stocks above the 40. If we look at 3-month new high, new low, this is where we were last week, and we just bounded. When we get down here, we get to a range that you expect a bounce, and we're getting close. Here's a really interesting way of looking at breadth that Sagar does. And the one thing that I've heard him say over and over again is you don't get major sell-offs without distribution in several of the major indexes. So you've got 1, 2, 3, 4, 5, 6 of them listed here. And you've got 1, 2, 3, and 4 had major distribution on Friday. You can see Dow, the NASDAQ 100, S&P 500, the S&P 1500. Yellow are stocks above the 50. White are stocks above the 200, and you can see across the board that those dropped significantly. Orange are how often the 50 is above the 200. And you could see all of these are giving bearish readings. Down here, you could look at advanced decline ratios, and you could see really massive AD deterioration. Up-down volume, again, massive deterioration. And then if you look at new highs, new lows, and new highs came up, and the new lows are getting interesting. If we look at the daily McClellan, if you want to see some good news, is if you look at the oscillator, this yellow line represents an area that we've bounced at multiple times. But keep in mind the white line, which is much further, is when we bounced in March of 2020. On the weekly, again, you could see we pulled right into the area. We're 6 points away from an area that you might expect a bounce. Current buckets, 83% of the stocks in the S&P 1500 trading below the midline of their Bollinger Bands. That is bearish. 25% of those stocks are below the Bollinger Bands. So you're at a place where you might expect sort of a snapback, where we're getting too many stocks. That's a quarter of the stocks in the S&P 1500 are below their Bollinger Bands. When stocks are supposed to be within those bands over 90% of the time, when they come out, you expect them to go back in. When you've got student body left, so many of the students of the stocks under the bands, you're going to get a bounce back eventually. Hindi confirmed zone. We did not see a Hindi on Wednesday or Friday. And the reason's simple. We don't got any more new highs. They're gone. Plenty of new lows. 8% new lows on Friday on the NASDAQ. Over 4% on the NYSE. A confirmed Hindi is when you get another one within 28 days or so. Well, we had 4 in a row on the NYSE. There's a confirmed Hindi for you. Market tone, you want to see a shot across the bow of the bulls. Notice how, if you can remember, In September and October, we were in a very choppy market, as you could see here. That choppy market was caused here by a shot line across of the red kahunas across the major indexes. You saw it again here, and you saw it again here in September. What reversed this choppiness was a series of bullish blue kahunas occurring October 14th. Well, if you look at what happened on Friday, that's pretty ugly. Not only do you have kahunas, but those are big ones. Those are very massive moves within the Bollinger Bands. The main timing indicator that Woody gave us, the Woody indicator, is essentially all red. So market tone is decidedly bearish. Now, if we look at summary of percent gain reports using the fundamental data on last Friday and looking week to week, so over the following week, first thing is the vast majority of stocks were negative. And if you look at it, relative strength, you actually did worse. EPS rank certainly didn't do much better. It was a bad week. S&P 500 was down 2.12. My stocks were down 3.85. My buy watch was down about the same. My filtered buys down 2.5. You want to see why I said growth leads lower? IBD 50 was down 5.9. The Market Smith 250 was down 4.19. And the weekend review was 3.71. So it's pretty clear that stocks like mine, like IBD, struggled last week. A couple other things to point out. The Canaries were down quite a bit. They were down 5.07%. And the Keepers, the list of leaders we put together a few weeks ago, was down 4.13. Now, are they done? I don't think so. We'll talk about that in a few minutes. Sector strength, in addition to a series of kahunas on the industry groups, you also got them on the sectors. This is the S&P 500. If we look with Cigars Tools, he's looking at sectors based upon the S&P 1500. Now, the beauty of this tool is this is a real-time tool, so I don't have to go run any kind of buttons. I can have this sitting on one of my computers, and I learn a lot from it. Let's start in the lower left-hand corner. These are the same buckets that I show you calculated in EdgeRater on the S&P 1500. The difference is it's done real time. We knew 26% of the stocks were below the Bollinger Bands during the day at the end. It was actually 30% before the market closed. That is an area that I start to look for reversals. What else can I tell you? I can tell you on Friday, very weak day, all the sectors were negative. Only 0.2%, or only 2% rather, of the industry groups were positive, and only 5% of stocks were positive. That is not a good day. If you look out over 5 days, it doesn't look that much better. 13% stocks were up, 5% industry groups, but all the sectors were down. Under 10 days, also very weak. A month ago, things were a lot stronger. If we looked at sectors over the last week, all of them were down in red, and you could see a lot of them were down over 4%. Communication, energy were some of the big ones to the downside. Over 2 weeks, all of them are down, including nearly 10% on energy and 7% on communication. Even over the month, they were mostly down. And if we look over here on the 1 and 2 days, you could see energy leading to the downside on Friday, minus 5.5%. But boy, it was just a very vicious day for the bulls. Now, when I go deeper in the Edge tool, and I could look at ranking anything by absolutes or by pace, acceleration. So I started by saying, what are the top sectors? And no surprise, in a market that is very turbulent, staples and utilities are up at the top. Communication services join them. Sometimes you'll see real estate up there as well. Those were the leaders. And when I looked at the industry groups from the leaders and I looked at those by pace, which would be the ones that had the biggest moves, these are some of the industry groups that are moving. And I looked at the top 5. I got a list of stocks Facebook made the list, Electronic Arts, Google, among others. And these would represent this list here, stocks that are undervalued and good earnings per share growth. I ran the same by just looking at the top performing, not by pace. And these were the top performing industry groups. And what came to the top again was Electronic Arts. Now, it was a lousy day. It's hard to find charts that looked really great on undervalued stocks on Friday. But Electronic Arts and the others on the prior sheet are some that I will be watching this week. Canaries in the coal mine, my extended FANG version, finally broke below the 17-day, had a new John Person sell signal, and you wonder, is it heading towards free parking, which would be the blue line, which would be a lot better than heading towards disaster at the red line. It includes things like BABA that really have had a hard time. Now, it's not listed there, but I believe BABA's in mine. I should take BABA out, but regardless, the Canaries sold off. The Keepers Index that we put together as a group um, is similar. I don't think it's broken. I think it's close. So I put down but not out, and maybe a rebound on Monday might get this back into safe zone. Why do we have the Keepers Leaders Index that we did together in October? We did it as an early warning signal when the market was done. I would think a break of the 50 is done. It's certainly in an area now where it's not feeling good. Know your news and earnings. There's a lot this week on the news front. Jobless claims on Thursday, payrolls, unemployment rate, earnings, PMI on Friday, orders, capital goods, beige book, manufacturing, PMIs. There's a lot of stuff coming this week. So it's going to be a relatively busy news. But I think the biggest news is whether or not the U.S. healthcare leadership will agree with the comments that came out of the South African physicians today saying that, yes, the Omicron is very contagious, but it seems to have a much lesser illness. So we'll see. Lots of stocks still have earnings this week. One of my favorite, Signet Jewelers, is there. Um, a lot of software plays are there as well. And as I put, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Market thoughts, you can read it. Big drop on Friday, uncertainty over the Omicron variant. Again, we heard on Saturday some more bullish comments. Market appears weak. We have confirmed Hindenburgs. We got divergences and continued COVID concerns. Clearly, the risk is to the downside. Look, I've been doing this long enough that I know personally that even though I could be very wrong and this market just goes crazy to the upside, I'll have plenty of time to get on board. Again, if we start to think that this strain is not a problem, then we'll see a relief rally. Like everybody, I took heat on Friday. I was relatively flat, so a little bit up on the week prior to then. I've got lots of put coverage. I'll sell out of the money calls, sometimes at the money calls to finance those puts, which means on a big up day, I'll probably trail the market. But on a big down day, I'll do much better than the market. Um, as much as I want to pile on the short side, we're technically getting close to an area that we might expect to bounce. This might be an opportunity to further reduce longs and enter shorts and contra ETFs at better prices. And again, any positive comments from U.S. COVID leadership on Omicron could lead to relief rally. And again, despite a relatively ugly November, the major indices are holding very well. So if you think I'm going to give you some outstanding bullish stock picks today, I'm sorry to disappoint you. I won't be. Let's go to this market force and divergence first. So over the last couple of weeks, I've been looking at the NASDAQ, for example, and saying, gee, when I get up to this level here, that would be the 19th. Now let's figure out. So today, the 26th was a Friday, the 19th was a Friday, and the high jump was 94.69. I remember this would be a week ago saying that typically suggests that we have a correction or a pullback coming. And what did we see? The market actually went higher that following Monday morning, sold off. confirmed now by the Laguerre RSI. We've got red candle, that's also a bearish candle. I've got MACD divergence here on the weekly NASDAQ, which still looks like it's in a buy, as well as the NASDAQ. So if you're longer term, this market still looks better. Short term, we may have some more pain. Certainly could come back and revisit the 15,600 range, which again would be another 400 points down. If we look here, what else do I see that's important? The weekly bongo, which is the center one, which is my longer term timing indicator, has not turned red. Don't need to worry about the high jump anymore. It's dropped down to 48%. Again, I don't talk about the high jump that often, but when it gets to this dashed line, which is 95%, it typically tells me something, whether I'm looking at the E-minis. So in this range here, it's telling you it's peaking out. Never got up to the 90 range, but it's got up to higher on the chart when you look at it. I think it's a very valuable tool. Now, when I turned this on, you were looking at this. Actually, you were looking at this one. And these are the futures set to daily. And not that I need to beat you up, but those who follow me for a long time will see things here that we saw back in late February 2020. First thing I want to pull you to is this. This is, I'm having a mental block now. Trend Trader Pro. This is his cycle high, confirmed with the red line. And when you see this, this often depicts some very high risk time in the market, that a market that's extended and is going to pull back. When I see them across the board, I pay attention. Notice the markets went a little bit higher, and then we started to see these dots, these pluses, this arrow, some of the different indicators I follow coming in. And these lines up here are sort of resistance lines, boundaries that Sagar's tools painted on. All of them have sold off. You look at the Russell, it's actually sold down to support. And this is an area that you might expect a bounce if the markets are going to hold. But you look here at the E-minis getting to this resistance area, the NASDAQs, the YM has broken through, and you look at the next line of support. So you could still see 1,000 points. Oh, that's horrible. 500 points gets you down here, and 1,000 gets you down to that green line on the NASDAQ. On the E-minis, you're 45.95. You're about 60 points away from the first line of support I would expect it to be. And then I hate to even think if 4,400 comes into play, because that's almost 200 points below where we are in the S&P. And if I look at the Dow futures, we've already broken through this. Again, we could reverse any time. But if I had to put my downside target, looks like about 33,800. I mean, that's 1,000 points more in the Dow. So it's hard for me to believe this is over. What I expect to see is a rally this week. It could be a ferocious rally, but it's going to take a little bit of more than just a couple of strong days for me to give up on my bearish thesis. And I do remember that in bearish markets or bear markets, we're certainly not in a bear market, you get some of the most ferocious rallies to the upside. So keep aware of that. Now in HGSI, I'll probably do some adjusting here because I am using a lower resolution on the road. Let's go to major markets. Doesn't belong there. Market analysis user groups. Major markets plus, hit the warehouse view. And let me resize this. I change, since I'm on the road, I don't have all the same tools, and the computer I'm using here has a resolution that is too much for my recording capacity. So I have to tone it down, which makes everything a bit of a mess. So let's put the top-down view on this, and the strength in this market, the bonds, the VIX, gas, dollar. Interesting, dollar bearish was down 0.6 on the week, dollar bullish was 0.6. When those things are at the top, And on the bottom are oil and small stacks, small caps, FANGs, Bitcoin, NYSE, IBD 50. I know I did not have a very good week in the market. So the question is not, did I have a good week or not? I did not, and I suspect many of you did not either. The issue is whether it's safe to continue in the longs. Do I need to lighten up? What are my expectations? So let's take a look at the market. Start with the S&P 500. There's a story behind why it says pseudo. That's something you can talk about with George. I can tell you that a lot of these entities that provide the indexes, quote, sometimes have a high expectation of how much money they should be paid. And sometimes you just stop and you start coming up with other sources. Wealth Charts, for example, has futures, but they use a different source than I would get from eSignal or somewhere else. They got all kinds of different names to them. But at the end of the day, they're almost the exact same number. And if you can get them cheaper, why not? So we start with the S&P 500. The good news is we're still way up in the right upper end, which is bullish. But if we look at what we see, these are the Hindenburgs that told us the market was weak. This was a red candle high. You see this in markets often that are at risk when they occur when you're near the high jump. That's typically a bad sign. Here is a squeeze with a MOBO breakdown. Here is a new John Person sell signals. We broke below the 17. On the Person market catcher relative strength, hard to really make anything of it because you're really comparing to itself. But you also had a kahuna to the downside. And this is a deep red kahuna because it was a big move. I look at that, I see a market that has some problems. I don't see a market that's going to, in my opinion, is ready to race to the moon. And if I'm wrong, I have plenty of time to get in. I've learned that over the years. You can see on the weekly, you got a low close doji there. Put it out here. And that's a very bearish signal with Hindenburg on the weekly and kahuna. I just don't feel very good about the markets right here. If I look at comparison, let's look at the Dow Jones Industrial. Looks very similar. The Person sell signal came in up here. Multiple MOBO breakdown signals. The Hindi is up here. Interesting, the weekly bongos have now gone red on the Dow, has not on the S&P. Kahuna, again, a weak market. Could it recover from here? Absolutely. I don't have a crystal ball. My target's going to be that 200-day moving average, which could be very painful for folks that are remaining very long right now. All right, what else we got? Come down here and take a look at the Russell. Russell pulled back, broke down below its 200-day moving average on the cash index. Its weekly bongo went green. And the part that disappoints me more on the Russell, to be honest with you, more so, whoops, I didn't just do that, did I? More so than on, that I'm just concerned about the 200 is that the Russell, oh man, oh my, I hate this thing, it scrunches up so much. Somewhere here's my drawing tool. No, that's not what I want. There it is. The Russell had been confined into this. And we had failed breaking out multiple times. I expected a retest. I don't like what we saw here. And that on the Russell worries me a lot. So do I think the Russell can come down to this level? Absolutely. Do I think it can go down further? Yeah, I think it can, unfortunately. 210 does not seem out of the question, which would have been the low of that box. Hard to feel real bullish here. I wish I could be more uplifting. The NASDAQ. MOBO breakdown from a squeeze, broke below its moving averages, Person sell signal kahuna. Again, above the 200, which is better than some of the others, but still one that looked to be at significant and substantial risk. How does this play out into stocks? Well, how about the IBD 50 ETF? Pull back to the 200. Now, double bottom, doing, And here, bounced a little bit off the bottom, although still was down on the day on Friday. Is this a good place to be buying? If the market holds up, maybe it is, but that's a big if. The weekly bongo is in, so I don't love this. How about the real thing? It's pulled back almost to the 50. That doesn't look that great. How about biotech? It must have bounced with all the vaccine stocks on Friday. And it did, but then the market sold off further. So it was up on the day nicely, but shooting star formation doesn't look real. I want to go out and love you and buy you, let it get above a chandelier stop. How about the Philadelphia semiconductors? Big leaders for a long time. Even they look like they're rolling over. So, really tough for me to look at this and feel very bullish. Now, on other things, I like to look at the dollar. For those who figured out the weekly on the right, daily on the left. The dollar has, is that a reversal candle? It certainly could be. If you look on the daily, you sort of have a evening star, gap up, doji, gap down. That would also be surprised that it's not considered a low close doji, but it's a breakdown here with a person sell. So the dollar weakness, paradoxically, might be good for my stocks. It certainly could help precious metals, energy, and others. Okay, now if the dollar's, wait a second, if the dollar is weakening, then gold should be getting better, right? Not really. Gold is struggling. So even though it's a risk asset, it had a tough week. If I look at gold miners, worse. If I look at silver, horrible. If I look at oil, which has been doing really well, um, Biden has been fighting OPEC. Biden did some strategic petroleum reserve releases, which means we'll have to buy it back someday at high prices, I'm afraid. Um, and OPEC basically countered by snubbing their nose and saying we might have to reduce some production. I think that market held up until Friday when we had the concerns about COVID and if that led to shutdowns and the end of travel. So the oil sold off hard as well. If you're looking for areas that might benefit if this COVID thing is minimized, think about travel, think about energy as places to start fishing for some values. Now, '07 industry groups hit warehouse. I've got 174. And this market's deteriorated so much, I've only got 4 groups that were positive. Now, that means I probably have a lot of groups that broke down, and I had 38. Now, I'm much better, I'm the first to admit it, at finding long stocks as a top down investor. When I see the market at risk of rolling over, I'm not good buying leaders that are extended that haven't broke down yet. I'm really good at buying things that go up when the market goes down, the contra ETFs. So let's start by looking at those industry groups that went up. Medical equipment has been strong and held up. Now, Allied Healthcare is a cheap stock. I don't know if this is a meme stock. I have a feeling that they do stuff with products that might be useful if there's a relapse of COVID. If you go back to February 2020, look at how it spiked here. It spiked again with resurgence, so with the Delta. So I think this is purely a COVID bump and not something I'm going to be chasing. The other one on the list was Catalent. I don't know what they do. They held up remarkably well, and that to me is very bullish. Maybe that's a cup and a handle. It looked like a failure, but now it's breaking out. This is one that I'm going to look at this week. It makes money. It's a medical equipment stock. I also like Hologic here. Again, kind of a loose pattern, not a big uptrend, but breaking out here in a very weak market. Back. Biotech, you would think this would be leading because of Moderna and Novavax, and you could see big gap ups on Moderna on Friday. Look at the weekly, how strong it is. Market cap, which was over 200 billion, is down to 133, still expensive. Long term, it's still in a downtrend, but you had a Bible gap up and a kahuna. Would I buy Moderna here? I don't know. I think that if I became a believer that they're going to be around making a new vaccine every 6 months for the rest of my life, I probably would start to buy more Moderna at this level. And that may be the case. Going down the list, the next one down is Aptivo. Don't know anything about them. Big downtrend. I guess they were up $1, which was 9.73%. I don't buy something that's a falling knife. I'd have to have a reason to. Novavax, finally moving up. Still doesn't have a U.S. approval. 133 market cap on Moderna. The market cap here is 16 billion. Imagine what this one does with an approval. Probably has a lot of upside opportunity, but it has risk. Incyte is an oncology company. I know they've got an excellent product on the market and a pipeline that they built with the profits from Jakafi, which is their product. It's a big company. Market cap is 15 billion. Certainly could be an acquisition target. But when I see the relative strength get stronger as the stock was following before it broke out, I pay attention. It was up a lot on Friday compared to the market. This is one to watch, but it's one that's kind of a bottom fish, to be honest. Repligen has been a leader. Pullback sideways, looks like it's ready to run. It's an expensive stock. I have no insight into this company. As with Cassava, not much less attractive. And Novio, no. Arcturus is one that's had a couple of big investments suggesting that they've got some good products they've sold off. Again, it's hard to buy stuff with this pattern. Any of these could turn out to be winners. Most of them will be losers. Beyond Spring, another one of these run-ups. Now all of a sudden you get a green candle low in a squeeze, a new person buy, pocket pivot, and a kahuna. You might want to play this one. I think they got an FDA opportunity coming up soon. So outside of the vaccine plays and maybe Insight, didn't look that exciting. Computer hardware and storage, HP. I still don't understand the difference between HP and HP Enterprise, the other company, but whatever. Really had a great day, I think, on some earnings on or news on Wednesday, and then maintained most of its gain from its Bible gap up on Friday. Certainly, you can own this stock and follow the Morales and Catcher rules for managing a Bible gap up. Pure Storage had gapped up, I believe, on earnings. Similar picture here. You could probably maintain this position as well. And Dell, another one. So a group that historically, it's been a long time since HP and Dell were leaders, but they both held up relatively well. And the fourth industry group, life sciences. These things, a lot of these bounced because of the COVID scare. And you could see on the week, most of them were down, but on Friday, most of them were up. Danaher, gap up here. Bruker, gapped up. Thermo. None of these really light my fire because if the news turns out that COVID is not a problem, the Omicron, then these things will come right back down. Um, is it okay to own them? Yeah, it's okay. I mean, some of these have just had amazing years like Thermo, but I think this pop here, Kiogen, they're all involved in testing. And again, if COVID becomes a bigger problem, companies that do testing will go up. The one that I own, and I took half the profits at the open on Friday because it was doing nothing. It doesn't look like it's doing anything here either, but it was up. It closed at 97.58. I sold half at 102 when it gapped up in the morning. Fulgent. So I look at that was the only bullish groups. If I'm going to be going long, I don't want to be buying groups that are to the downside. I do a bottoms up where I try to look at the market. And as always, I found a number of stocks. But do I have many of these stocks that I'm going to buy on Monday at the open? Let me be clear. I have no stocks, zero stocks that I am interested in buying on Monday at the open. Let me say that again. I have zero stocks that I'm interested in planning on buying at the open Monday. Now, the futures may be amazingly positive, and I will reevaluate that. So these are the stocks that I put together on my short list. Three of them, Asana, well, more than three. So we got Asana, Affirm, Upstart, Snowflake, DigitalOcean are all kind of woulda shouldas. Stocks that some I owned, some I did not own, I wished I'd owned, and they've all are they fallen angels and they're done, or are they setting up for new buys? This is DigitalOcean. Um, this is Asana. Is it done going down? I don't know, but it might be. This is Affirm, and then Snowflake. Here's Upstart. Hold on, and then Snowflake. Each of these stocks were big leaders that if the market was strong, all of them look interesting to me on pullbacks. C is one that I'm in and out of. I have a long-term position that I'm still in, although I sold some options against it when it was 350, 360. It pulled back to the 50, and what is it? It's usually a buying opportunity. Again, if the market doesn't go up, be careful. It was up 2.5 on Friday. Anything else here that I really wanted to call out? When you see things like Kellogg's and where's my wife's favorite, Clorox, she couldn't believe that they actually have their own company. These are signs of a bad market. Here is a stock that is sold off as the markets have had a good year. And then what happened on Friday? A mobile breakout from a squeeze, a big move up. Pocket pivot, Kahuna, New John person buying it pays a 2.6%. Will you go rich buying Clorox? No, but you can at least gain a dividend if we go into a bear market, and this is the kind of stock that's more likely to hold up, as is Kellogg. Starbolt Carriers is one that I already own. I added to this week. Pull back to the 200, had a big move on Wednesday, and then on Friday, sitting right below a chandelier stop. A break above that in the 50, the stock could easily go to 26. Options are relatively cheap on this. Its PE is 5. It pays a 4.8% dividend if you buy the stock and look at the earnings per share growth. Um, Again, as I said, there's not a lot on this list that I want to go out and buy on Monday. Here's Zim, which has been a great performer. I should have included it in that original group. It's in the process of a flag here. A breakout on Zim, I might be interested. But none of these are running right now. Marvell Life Sciences is one that was a darling here, sold off starting in August, and it looks like it's bouncing here. Now, is it too early? Sure, let it get above those moving averages, maybe even get above the PSAR dot. So there are things in the list that look interesting, but there are very few that are ready to buy right now. Now, I mentioned contra ETFs. So I played a lot of them. If I think the NASDAQ is weak, I know that the NASDAQ, the majority of the NASDAQ is the NASDAQ 100, and the triple Qs is an ETF of the NASDAQ 100. I've made a lot of money this year by shorting this or by buying puts. What I typically do is a put spread, and right now on this, I have some 185, I believe, 165 or 185, 160 This 185, 165 puts, um, they're max in the money right now, but they don't expire till Friday. And the 165 puts are expensive. The 185 puts are really just the delta between the price because there's not much time value in them. So I took some profits on Friday, and I'll probably take more profits every day this week on them. A big reversal in the market, I'll probably close the position. But triple Qs is one way to play short. Short this if you think the market's going down, long if it's going up. You don't want to buy puts or go short, you can buy the ultra short Q ETF. Now, the problem with this one, because of all the splits that these things have had, negative splits, reverse splits, look at where this stock is. I don't like to buy a $6 or $7 stock and play it to double to 12. I'd rather buy something that's at 180 and play it to go to 90. But SQQ, let's say I think the S&P is the place I want to short, SPXS. This is a short ETF. Again, because the market's been up for a long time, it's relatively cheap. So this would go up if the market goes down. SPXL is the long 3X ETF, and this will go up if the market goes up. I like to short this one because I can make a lot of money. This will move a lot more for me. If you want to short the diamonds, you could go the dogs, okay? And these will go up, as you can see on the weekly. They go up when the market goes down, or that's going long those, or you could short the diamonds, which go up when the market goes up. For that matter, you could short spiders, very liquid to short, and take advantage of what the market does. So within HGSI, one of the cool things that they give you, a couple more things to show you and we'll be done. This is not an exciting call today. I apologize. Blame the markets. Go into the reference groups. You can come in here and look at major index components. And you don't want that one. Hold on a second. Component lists, ETF components. These are the major ETFs. I don't know how often these things are updated, but this shows you the stocks in these ETFs. Now, I usually use Direxions. Let's see if I can find them anywhere. All right. So here's a list of the Direxion ETFs. And what you'll see are a series of bullish and bearish ETFs. What makes these things fun or hard is this. These are all leveraged ETFs. So let's say that I know that natural gas seasonality is very bearish right now. Well, there's a KOLD, which is a short natural gas ETF. Since it's a short ETF, if natural gas goes down, as it usually does seasonality right now, then this thing goes up. So I might look at coal. You could see if I believe bonds are going up and I want to do a leveraged bond play, here's a bull 7 to 10 year bond 3x ETF. So you would get 3 times the return. It pays a dividend yield 10.8%. And this is TYD. The challenge with this is if you drop back down to 48, you used up your whole dividend yield. If you think biotech is going up, you could buy LABU. All right. If you think it's going down, you could buy LABD. So a lot of people have accounts where you can play the contra ETFs. So the ones that I like to use and that I use a lot of are, if I think gold is going down, I buy Dust. If I think gold is going up, I might buy Nugget. There's energy ETFs, ERX, ERY. Financials have been hot. FAS, which represents financials, has had a big run. If financials break down because of dollar weakness, then you might short FAS or buy FAZ, which will go up. There's the biotechs, LIBU, LIBD. Here is the S&P 1X, 2X, bulls at 3Xs, technology. So there's an ETF that can serve any need. So I look at this and say to myself, if I think the market is going down, do I want to short individual stocks? And I do that. And I actually have a list that I put together this week of some potential shorts. But frankly, I've made a lot more money not shorting these things, but by either shorting or buying long the 3X ETFs. So let me just clear that and go down here. And I can tell you my shorting list was down from last week, which means it was up because I was short. So shorts last week would have done fine. So I use these more as a sort of a guide to what the market is doing. These are some of the stocks that made my shorting list this week. Now, typically, look at Home Depot. It's been a leader. It's starting to break down. It's a high risk stock to short. Okay, why? Because it's flagging. It hasn't done anything bad. Now I know if the market holds up, it's probably going to go on to new highs. But if that drops, that tells me something. Um, Tesla, hard to short Tesla. I'm not saying to short Tesla, but Tesla's in a funk right now. Tesla falls down to the 50 or the 200. Does it bring the market with it? It might. Nvidia, another big leader. So I wouldn't call this my shorting list as much as a list of stocks that have been leading that I'm looking for as potential signs that this market is rolling over. Now, again, we've built a list called the Keepers list. And if I look at the index group in Keepers, we can see not that it has not broken yet. That's another thing that I'll be looking at. Now, the last thing I wanted to look at with you, and this is one of the powers of scanning, whether you do it in TradeStation, Thinkorswim, whatever, HGSI. And the challenge with HGSI is simple. It doesn't have a lot of outside folks indicator sets, and I don't think we're big enough that they're running and knocking down the door. And I'm not crying about it. I'm not complaining about it. But most who've been around for a while know that I took a lot of heat when I put in John Persons for John, with John, and then John charged a fee to get access to them. I got zero, but I got a lot of heat. So I'm not going out and doing that anymore. But Sager, for example, has some scans. His go with flow long and short scan. Um, I look at it every day, and these are trend changes. And when I see there's Winnebago, which is always big when COVID is bad, 19 uptrend, new uptrends, and whoops. And I look on the downtrends, 100 and 100. That tells you there's more bears. If I look at John Persons, on the bullish side, he had 19 new PPS buy signals. I think this is just a buy signal, nothing else. Let me see what's in this one. Can't always remember. I did these things so long ago. Edit, scan, criteria. All right, so this would be, they're in a weekly buy and they just flipped a daily buy. I think 4 is all the buys. So all the new John Person buys were 52. All the new John Person sells were 364. That tells you the weakness of the market. If I want to look for a stock, for example, how about I want to look at something that is traded up to trend line resistance. So stocks run up and maybe it's reversing here. Let's look at Calm. I haven't looked at any of these. Traded up here to trend line resistance, a reversal. I don't like the picture. But I might find opportunities for shorting within here. Fulgent, that's not on that list. I might want to look for price at extreme high and reversing. These are bearish pictures. Let's look at, pick one. Let's look at Anthem. Reversing off a big run up. Now, if it breaks through here, you'd expect it to drop down to this support. So I'll use my scans to help me find stocks. I have a lot of different scans that I use. Roy Kelly was the one that does the cycle finder. I had a mental block. So I use my scans mostly after hours to find stocks that I might want to buy or sell. During hours, I load my stocks I'm interested in a series of different screens like this. If I want to look at stocks that are giving me a pullback buy or sell, here's a number of stocks, a couple which I mentioned, that are reversing. So let's look at Snow. Let me set the colors, my bad. Call it Cyan, Cyan, Cyan. So if I look at Snow, I know, because I've used this before, it's got a stock that's pulled back and had a reversal candle here. Okay, that's interesting. MDB has earnings this week, so I wouldn't touch that. What about a breakout? A lot more breakdowns and a couple of breakouts on Friday. Well, big shocker, one of the breakouts was TLT, so this tells me it broke out of resistance right here. So that looks really exciting. So I can spend my time looking at charts. I can look at radar screen intraday. I can use scanner at night. And for those of you who use Thinkorswim, you can load your stocks into MarketWatch and do the same things. And then also the scanner. Let's see how many of these we find. The scanner in Thinkorswim is very powerful as well. On that note, be careful this week. I think there's a lot of potential for this market to go both ways. Pay attention to what they say about the Omicron version of COVID. If you hear things that are scary, then I think this market is going to follow through to the downside. If it doesn't seem so scary, we do have positive seasonality to think about. If they come out and say, we don't need to worry about it, then look at those energy and travel plays. I think the most important thing you can do is to protect your capital. Don't go out and chase. Have a great week, everybody. I didn't know if I was going to do these or not. And my two favorite words of the day, go blue. Good night, everybody.